Okay, here I am again, a little schizophrenic because I'm making some videos about excuse me, making some videos about a finance class, and I'm going to talk, and now I'm continuing chapter one. Okay, I suppose I just watched a video, kind of, just put the whatever, hovered over it from our friend, your friend, the person you all know, Warren Buffett. I'm sure you know him well. And he said, "Oh, business school is just a waste of time and all that." I find that a little irritating, especially for people who went to business school. And I don't want to be somebody who just moans about, okay, the real markets are different, markets are not efficient, and all the classic kind of crap, including the CAPM. People all know that doesn't work, so that's not a new. Hopefully, that's not new. I'm just like I said. I'm der wütende alte Trottel, the angry old man here, idiot, who's I'm going to go through in this video. I counted 19. By the time I am finished with this book, I'm sure this list will increase or decrease, although I am trying to really get finished. And I want to go through very specific things that are wrong instead of just general BS. Okay, so here's my list. And in my list, I'm going to try to explain a little what I mean. This is in certainly no particular order, but I heard on this television channel that's owned by Disney in the U.S. that this expert, this expert, she was on the television, said, "Oh, the stock." This was before the decline this year or last year, whatever. "Oh, the stock market's grown by 10% for the last few years, so you should expect it to grow. That's kind of what you should expect it to grow." Or worse yet, you see estimates of the famous equity market risk premium. How much do investors really need to take this big risk of volatility? If you have a gigantic portfolio of stocks in the whole economy that starts to, you don't have to have that big a portfolio to get it, and you think, well, the economy is growing at a real rate, maybe of 2-3%, the productivity times the population growth or something, and our companies are supposed to grow. Well, you could even say the number of stocks grows, so you could look at the total market value even rather than an index, and then you say, okay, well, the stock market's supposed to grow on average by 8% or some crazy thing like that. And then you realize if that happens, people own stocks. Of course, I've said this many times, get really rich. But if you take the past history of stocks and the returns that stocks have earned as an index using the stock market, and then try to convert that back and say, well, that's representative of the rate of return companies should make, you've missed capital gains. You've missed the fact that interest rates have been on a gradual decline. It's changing now, but we're talking about real interest rates. They have been declining year after year after year. And when they decline, capital gains are made, and you can have exactly the company with exactly the same earnings power, earning, let's say, 5% something, some kind of return, and their stock going up because interest rates go down because the real cost of capital in the economy goes down. And so if you're trying to take the estimates of the market index and translate that back to something to do with to suggest that companies, if the stock market goes up by 10%, like this idiot on the television said, or 8% or whatever, these ridiculous numbers, far higher than the real growth in the economy. When the stock market is supposed to go up like that, and then you say, well, okay, that means companies have been earning 8 and 10%. How ridiculous, without ignoring. And that's just number one. Oh my God, I was going to put my timer on. Now let's go to the second one. And I love to kind of criticize specific people. I remember there was a class, and there's a lady who centered the whole class, around this formula, the return minus growth, 1 minus the return divided by the growth, and we proved that in a couple of lines. You just take the whatever evaluation formula value is the dividends divided by WACC minus what the cost of capital minus growth, and then you put the dividends, you convert that to the payout ratio, and you easily can prove it in a minute. And it's a nice formula. If number one, you knew how to define the return, and we're going to go crazy and see it's almost impossible to do that. And when McKinsey has some graph of the rate of return, oh my God, and their proprietary database, what a bunch of rubbish. Return is a problem. And then this, of course, the whole business of valuation is thinking about whether a company's return is going to go change more faster or slower or whatever, change compared to what the market thinks and all that stuff. You can get all theoretical. And this formula, you just can't get it to work in a clean way when the return changes over time or the growth changes over time, which is the whole point. So it's an okay place to start, and the cost of capital also changes. And I'm going to work through some of that with you. And okay, so I'm not even criticizing their really business schools yet. I haven't done that. And then this third one, well, it irritates me so much I can't stop, and I've made videos on it before, and I'm sorry to repeat this. In a sense, this book is just pudding because maybe I'm worried about getting old and having a book before I die and all that stuff. Whatever, I can't pronounce the guy's name properly. Okay, I wasted a lot of time looking in because I did a study for Pakistan. It was kind of fun. Whatever. It was wonderful. I'll stop there. Okay, we know the results are nonsensical. We know that the implied default rates in these cost of capitals, the implied the amount of money you have to make in order to earn these risk premiums is totally absurd. We know that. But then when you look deeper, you see that this is like this thing that I had some friends and they never heard of the Wizard of Oz. I loved it. Those guys, there's nothing there. There's nothing there. You look and see how it's computed. It's all computed kind of a little bit from some vague Moody's bond ratings. And then when you look at countries themselves and you see, well, the countries are, the banks in the countries have credit spreads that are very reasonable. They're not so different than credit spreads elsewhere. How could a bank possibly exist? How could not all the banks go bankrupt if they don't charge these enormous credit spreads reflective of the country risk premium? Worse yet, we know some countries might be a little bit dicey when it comes to honoring some kind of contracts, for example, electricity contracts. That does not mean buying chocolate is riskier. When I go to Nigeria and I see, oh, there's chocolate in the shop, I went and bought it. Is that really? Do I have to pay a big premium for a bar of chocolate? I shouldn't eat so much chocolate. Do I have to pay a big premium for that compared to buying chocolate in Switzerland if I go to I think it's Nigeria breweries or something and buy a beer there? Do I have to pay twice as much for this beer because the factory that it's built means that there's more volatility and there's more business risk associated with making beer? It just doesn't make sense. And we're going to try to look and get some real data. The company that we can really use is there's a Nestle Nigeria, a Nestle Pakistan, a Nestle blah 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 Myanmar or something. We can look. They all have stock prices, and we're going to try to look at some of those to see if we can do a more objective kind of valuation. Okay, in looking for replacements for the IRR, I've already told you that I think I might have something that's a little bit interesting that says let's compute the earned risk premium and use a risk-free discount rate to compute this earned risk premium and get totally away from the cost of capital. This MIRR, modified IRR that Excel put as a function, they didn't at least put XMIR. I'm embarrassed to say that I made that. This depends on the discount rate, and when you have different MIRRs, they all say, okay, we're returning whatever we input. We input a discount rate of 6%. The IRR is going to be close to 6%, especially over the long run. Okay, it's just crap. And then when you get fancy, let's look at M multiple of invested MOIC. Oh, it's so good. Well, you add up the investment you make and you add up the cash flow you get. That's no different than a payback period, which is all the criticism. And okay, we can argue for a payback period, but when you get fancy with this stuff, what a lot of crap. That's not business. I'm not even criticizing business school there. Now, in number 5, I am here a little bit. Merton Miller, I thought, was amazing. He put things in relatively simple terms. You can watch a video called The $1 Trillion Bet. I need to put that on my website. It's ancient history now, from the 90s. And he's interviewed and he's trying to explain things and he's really calm and he doesn't start babbling and he did arbitrage. He said, okay, if we have debt, we have a company that has debt, and then the company can issue debt or we can get the stock and buy the debt on our own behalf. He didn't look at credit spreads and taxes too much and all that, and then he adjusted for taxes. I shouldn't say that. And that's arbitrage. He said, okay, it shouldn't really matter. And at the end of the day, you should focus on the operations. You should even focus away from the contracts a company has. Focus on what they really, really do. And that's return on invested capital or project IRR. And that's a good concept. But we've taken it too far. We're going to solve these problems by really looking at how, and it's remarkable. I'm not, saying bankers are great by any means. They made incredible mistakes, and they've done, and I was one, of course, bad things. But they study things. They have engineers on their staff. They hire consultants. When they lend money, it's a stamp of approval. It's incredible information, and it implies that equity returns, the banks are really adjusting the risk. So if you have a really risky company, they're going to have low debt, or project at least. A high risk company more, and your incentive in project finance is to go get as much of it as possible. So by telling you how much debt there is, they're telling you what the equity IRR is. Please don't McKinsey goes crazy with ROIC instead of ROE and all that stuff. Please, in these, at least in these situations, it's really the equity return that matters. And I have to tell you something else, that this, a ratio called the debt service coverage ratio. It is the beautiful measure of risk. It the and it's not in oh my god, can you imagine talking about DSCR in front of a finance professor who's talking about beta? Oh my god, DSCR, if you have a meeting in a city you've never been to, like Lagos, Nigeria, and Google, you do a forecast with Google Maps, and it says it's going to take an hour, and the meeting is with your CEO. I use this example way too much. I do an experiment where I say, well, how much more time would you leave to make sure you're not going to be late for the meeting? That's risk. That's risk. And the DSCR measures that risk, or alternative debt statistics measure that risk. And it's very, very difficult to find a better measure of risk than how much extra time do you have to leave to compensate for things like volatility and traffic, uncertainty with forecasts and everything else. Let me take a break. And now I get to go through Harvard case studies. Now, I do criticize these a lot because they're just such a joke. You know, I looked at these Harvard case studies that are used in valuation. And when it comes to terminal value, they either put some vague, they do about three things. One, use a multiple. Two, use some sort of Gordon's method where you take the last period's cash flow and you just grow it without knowing what capex is underneath there, and that's my criticism right now. Or number three, even trying to do a little more sophisticated capex and put the ratio of capex to depreciation in there. Okay, last one, it's getting there. There are three things in any forecast. There are revenues, expenses, and capex. And if you get the capex wrong, which is what's wrong with all the earnings forecasts and everything else, your terminal value will be a joke. And there is not one Harvard case study that comes anywhere close to working through how to evaluate the capex that are necessary to sustain a growth and the capex that are consistent with a return on invested capital. Okay, and if I sound a little vague here, I'm sorry. We're going to go through and really study these. I'm just giving a little bit, like some very nice man said, a little teaser. I'm giving you the book. It's not totally a teaser. Now, when I saw these things, these things where you're supposed to get the beta ungeared, unlevered, or asset beta of an industry, and you're supposed to adjust for the gearing. It's old, our friend Merton Miller, who would have started this whole kind of business. And when they do that, and then you can then take this weighted average cost of capital, which I call what absolute complete crap. Sorry. And you put the beta in, and then you put a cost of debt in that's not the risk-free rate, the whole thing doesn't work. You can take 3 minutes and prove it. So you need to have some sort of risk on the debt. And then they say, we'll just compute a debt beta. What a bunch of, oh my God. How can you have a debt beta? Can you believe that some corporation has some big, gigantic, or bank has some portfolio and they're all worried about, okay, I've heard of that, yes. There's no, you can back into the implied debt beta. I've tried to do that, but I'm almost embarrassed. The whole thing is just, the whole thing, which is always shown, and oh my gosh, you think it's fancy, it's just a bunch of crap, okay? The idea, I shouldn't say that, shouldn't quite say that. The idea of taking some financial ratios, in this case a beta, readjusting these financial ratios and trying to come up with some representative one that represents an industry, that's okay. That's okay. but the way it's done is remarkable. Of course, now this sounds just so obvious to me when I write it down. How can it be? My friend Mike told me that he took the CFA and he did extremely well because he worked so hard at everything he does. Certainly not shocked. And he said, they said the cost of equity is always kind of higher than the cost of debt. I just, okay, you better answer it like that, Mike. Don't get wrong. But of course it's not true. The most extreme cases are of course, when you have a company that's kind of on the verge of bankruptcy, and the debt cost the debt cost is very high to represent the credit spread because we only have downside in the debt, but the equity, there's a little chance that that company will do okay and it will have a big upside on the equity. Of course, the cost of equity, but that's just an extreme case. In general, how can you take something that's inherently, whatever, a sold put option or whatever you call that, where you've got a flat, credit spread you can earn and then a downside, and compare that to equity that might have a kind of nice little distribution, or it might have an upside that I argue project finance always has, and a lot of equity always has. And how can you possibly start comparing the cost of debt and the cost of equity? It's just amazing when you sit back and think about these things. And I'm in the very last chapter. I'm going to try to kind of go through some simulations and see if we can't actually quantify this. Okay, one of the most irritating things I have is these. I can't watch it. I can't. Watching loudmouth people on television who claim that, no, we're going to do a valuation and we're going to get a PE ratio, and I just opened a McKinsey thing that said the PE ratio is always about 15 and it always stabilizes, and there's some magic thing to a PE ratio, and then not understand, and then doing almost the same with EV to EBITDA ratios. And some people say, EV to EBITDA ratio is much better because we don't have all the crap of the accounting and earnings and whatever. There's so many things. I've already mentioned this. There's so many things that are wrong with this, and the difference between the distortions in the PE ratio and the EV to EBITDA ratio are really big, and hopefully we need to understand, instead of just they're bad. And even in business schools, you'll see, they're bad. Everybody will see they're bad. We can't compare companies for some reason. We can't compare the growth rates. That's the easiest one. Okay, but it's the interaction with the growth rates and the returns that really matter. And it's the fact that if you have old assets or new assets, all of this really makes a difference. Let's learn that. Let's work through it. Okay, now I finally get to go through the CAPM. Now geez, I'm spending so much time on 2 little pages, but if you've ever done what I used to have to do, which is to really work through the CAPM, try to compute betas yourself. And understand, when you compute betas, you get a different answer if you use a daily, monthly, or weekly data set. Or you start really thinking about the risk-free rate, and you said, we can't use a 10-year treasury rate because that has a gigantic amount of inflation risk. So what are we going to do about that? Or you start getting into the equity market risk premium and just see just how horribly it's computed, and nobody is. The only real way to do it perhaps would be to do some sort of an implied valuation of every single company in the market, which could be done. Maybe it would be very rough. But the problem is not this ridiculous crap about I got to read this a little bit better. Okay, enough of that. I think I've skipped one. Okay, excuse me for this, and I'm not going to redo the video all because of this either. The arbitrage pricing model. Oh, God. If we just throw a couple of other factors in, how can you take this seriously? Nobody could use it, of course. How could you possibly say that this is the alternative to the CAPM? When you think of the arbitrage pricing model, think of an oil investment. And think, or you could use this with merchant electricity or any kind of thing where there's a forward market. And you could make your models or your estimates or your cash flow evaluations in two ways. One is to ignore the forward market and use a discount rate that reflects the volatility of oil, natural gas, electricity, something else, whatever, steel, whatever. Or number two, you could say, I'm going to take this same oil field, the same electricity plant, exactly the same thing, and I'm going to hedge in my model. I'm going to put a forward price in. And then when I get to the discount rate, I'm almost going to put a risk-free rate in. Okay, we have a little O&M. Probably a risk-free rate is pretty close. That, for me, is the arbitrage pricing model. It's an elegant little thing to do. Oh, that's what we need to do instead of this junk of throwing variables in. Okay, let's talk about WACC. WACC, can you believe WACC is wrong? Can you believe that when you think of value and asset, and if you have this gigantic government grant these days, you get this in U.S. you get these investment tax credits, and when you're putting your capital structure together, if somebody gives you a big present and somebody reduces your cost, you would reduce the debt and the equity, okay? Or you could do. I don't want to get off track. Whether you'd call this a grant equity or whether you call it debt, the fact is it's a grant. The fact is it reduces your cost, and then you still look at the cost of the funds providers, the debt and the equity. You don't say that those debt holders they need 6%, so we're going to lower that to 4% because of the tax rate. You don't do that, and that's what the tax shield really is. It's a grant. And you can prove it. You can prove that it doesn't work. For all these decades and all these years, this WACC has been used. And that's not why I call it what absolute complete crap. I call it what absolute complete crap for other reasons. Okay. And in the last chapter, I'm going to prove that. Okay. Nobody will ever get to this last chapter, even on listening to me on the videos, perhaps. When I used to take these reports from Standard & Poor's and Moody's seriously, and I've seen people in I don't know, in not in business schools perhaps, but in these other classes, these professional classes, say, oh, go and read this S&P report. Ooh, read that, and something, or okay, shouldn't go if they're getting into a specific company or industry, maybe they're okay. But this peak to trough and this business of how we take something like a debt to EBITDA ratio and then we adjust it for the business risk and we have some kind of fancy little matrix that does it, or nowadays you go and you let Standard & Poor's do your credit ratings for you. Oh, it's just unbelievable. Absolutely unbelievable, just the rubbish. When we really think about risk, and when we go through our project finance, that's what they have to do. They really start to think about risks. There are mean reverting cyclical risk, which might take years, might take a decade to resolve, and they might not ever kind of resolve. They're cyclical. But there are other risks like obsolescence, like going out of fashion, like getting your estimates totally wrong, just making raw estimates completely wrong. Understanding the difference between something that's mean reverting and that has a permanent change that can just make something go down to zero, like Victoria's Secret or something like that. That's how we should think about risk. And then it's, of course, very difficult to quantify. We can't get this stuff from we can't get it from financial reports and all that, but we can try. My favorite target is now this Amsterdam Institute of Finance, who I used to work with. They don't want me, but they want to. They have this course. Oh, we can find an innovative way to look at financial statements. We're going to dissect these things. And we're going to pick them out. We're going to find, uncover value and all this. Oh my God. It really is. Stamp out the chartered accountancy. I love that old stuff. The I'm sorry if you're accountants, and everybody needs to study accounting. I'm not saying that, and I'm not saying that we can't have financial statements. Of course, you need them, and I'm not. I argue for economic depreciation later, and I argue that just about on so much stuff. But if we try, it's almost just worthless to compute a return on invested capital. Unfortunately, I used to be obsessed with that, and I still am, and I'm still going to go through how to split up the balance sheet and do some of the technical stuff. But you've got to understand, it just doesn't work. And I've already said, when McKinsey shows you this graph of the return on invested capital for companies in the high quartile and low quartile and how they descend or grow. What crap, when you can't come close to computing that statistic, and then they take a goodwill out of this. Absolutely unbelievable. And people look at this thing and just accept it. It's like when they measure synergies. Oh my God, how could you measure synergy? Synergy is earned when you buy a company and the whatever, you have cost savings, or you fire people, whatever you do, you get more market power, whatever you do. And by definition, how much the synergy is how much you make after you buy a company compared to what you would have made. You don't know what you would have made. You can't measure the synergies. It's unmeasurable. Okay. I talked about this CAPM stuff, so that's what I was doing, and I'm almost finished. I need a break, a breath. You know, when you think about terminal value, and but this is fun. I'm sorry. Doing some mental gymnastics here is, we need to step back and do that instead of listening to people who are going to give us a formula. And we need to understand that the long-term value of a company comes from their existing assets, fine, and they might have had some fantastic film, or they might have had some Michael Jordan gym shoes or something like that. Yeah, that gives you a whole lot of value, maybe for a long, long time. And maybe you get a really high return, like Justin Bieber or some whatever that guy. But then when we're valuing a company, we're valuing it forever. Of course we are, which means that the cash flows are enormously affected by the discount rate. How you're essentially making a proposition when you value things forever about how effective generations of management from now are going to be in earning this return. And making an assumption that they will never be able to earn any sort of return is kind of a silly assumption, perhaps. You can argue that. Because why would you be in business? Then you might as well close shop. But making an assumption that this management will forever continue to be able to generate really high returns is, of course, even sillier. That's a philosophical idea. And we need to split the pots out and understand how they're really being earned. And that's why I'm going to go through some specific case studies. Oops, it looks like I have to do a line break here. I've already talked about this, I think, before. The fact that when you look at Value Line and Market Watch, and you get a dramatically different beta than when you look at Yahoo, and you can replicate Yahoo by downloading the stock prices and just computing the beta, and why you'd rely on this laughable idea that the betas all are multiplied by 0.33, the 0.67, and then you add 0.33 to that, and you just adjust them downward or upward, when you can just take a sample and split it up and say, oh, let's look at if what the beta was this 5-year period, this 5-year period, this 5-year period, and you don't see anything. And how you can just accept this without knowing what's in there is just mind-boggling. Okay, and finally, this I really believe, partly because I've testified on this a lot, but I believe there's so much. If you really think about the world, I'm sorry if I'm not. This is not political, please. But if you think about the world and you think about the inherent, people want to justify the investor class earning high returns. Okay, fine, good, fine. And how'd you justify that? How'd you justify that the investors get rich? Fine, good. No, please don't yell at me about that, please. Well, you go to your business schools and you start saying there's an equity market risk premium of 6%, which is so much higher than the real growth in the economy. You start pushing people and you start saying the economy really works out well when companies earn a really high return by charging higher prices, of course, and there's so much inherent pushing in these theoretical ideas. That's what I'm going to leave you with. Now, the rest of chapter 1 just goes through the theories. Although, no, let's read this one and then finish. As they inched along the traffic jam. This is from my favorite Harvard Business School quote of Bombay. Taxi cabs, I can't read, on Marine Drive. Rebecca Mark, an Enron person who did not go to jail, and Joe Sutton, I don't know who he is, received an intense reflected on the intense negotiation efforts of the past year and what had been accomplished. Their company, Enron Development, what a great company. We're going to worship this. We worship this company you notice there are a lot of religious references here. The development arm of Enron had been attempting entry into the huge Indian market. EDC, Enron Development Company, was headed by Rebecca Mark, its youthful, energetic president and CEO, who got her MBA at Harvard Business School. Oh, it doesn't say that, but I'm assure you that's what it's all about. She summed up her philosophy. We're an eclectic bunch with some ex-military people and some ex-entrepreneurs. We are brought together with a certain amount of, I repeat this so much, missionary zeal. Why would you teach Harvard Business School people that they're going to go to another country and become missionaries? I think the missionary zeal that you have to be in this kind of business, it demands so much of you all the time that you really have to believe in what you're doing. Oh, they believe so strongly in doing good things for India. You should be throwing up right now. I think for us, this missionary zeal has 3 parts. Sorry, there's a background because somebody's not respecting my video. First, the prospects are good for the country. Oh my God, we're doing good for the country. Here's the real thing. When I work through this case, I have people compute the IRR. The IRR on the project, not the equity, 17%. And that 17% is an IRR based on an incredible inflated cost. When you look at the true IRR they were trying to earn on this project, it was somewhere in an astronomical 30-40% range. And when this project fell apart, it was the biggest project that had ever been done whatever, direct investment to a foreign country. When this project fell apart, it happened to be correlated with the falling of Enron. I don't know if this was the reason or not. Okay, and I'm using my hands too much. And I'm being interrupted in this horrible way. And then let's just go to the third one and finish this video. We're bringing a market mentality. We're getting this 34, 50, whatever percent IRR. Really, the nominal IRR is 17% you can get, which is astronomical project. Oh, and spreading the privatization gospel. How can they do this in countries that desperately need this kind of thinking? We are in the business of doing deals, this deal mentality. And when they did this deal, I've heard stories, and I'm not going to say anything because I might get in trouble, but I've heard stories about what they really did. This deal mentality is central to what we do. Okay, enough. I just had to go through that one and then the chapters. Okay, I couldn't not talk about that. And let's see, this video went on a little bit longer. Not that much longer.